So think about this for a second. A donated heart, right? It needs to get to someone maybe hundreds of miles away, and the clock is just ticking mercilessly.
It's a huge challenge. Traditional methods, well, they have their limits. Serious limits.
Right. Keeping organs viable outside the body.
Yeah.
It's tough. But what if there was a way to not just preserve it, but actually keep it going?
Yeah.
Assess it even in a sort of near natural state.
Well, that's exactly the ambition of TransMedics Group, ticker TMDX. They're really trying to change the game in organ transplantation.
With their organ care system, the OCS.
Yeah, the OCS, and also their whole national OCS program, the NOP. It's a whole package.
Okay, so this deep dive, we're going to unpack TMDX. Look at their business, who's running the show, the financials, market view, ownership, the whole picture. Risks and opportunities, too.
And it's all based on the research we could pull together as of, May 20th, 2025?
Exactly. And just the usual reminder, this is purely informational. We're not giving investment advice here.
Absolutely. And you kind of have to mention the stock price action, right? It's been, pretty wild.
Yeah, I saw that. Up 81% earlier in May, and now, 90.78% year-to-date?
Incredible. Closed yesterday, May 19th, at $122.10. That puts their market cap around $4.1 billion. So, yeah, something's definitely caught the market's attention.
For sure. Okay, so let's get straight into it then. What exactly is TransMedics all about? Let's dive into Chapter 1, Understanding the Business.
Right. So, at its core, TransMedics is trying to solve that preservation problem we mentioned. Their main thing is the OCS technology.
The organ care system.
Exactly.
Yeah.
It's a portable system. Think of it like a little life support machine, but specifically for lungs, hearts, and livers outside the body.
Okay, so how's that different from just, putting it on ice? Cold storage.
Big difference. Cold storage basically just chills the organ, slows everything down. The OCS, though, it uses warm perfusion.
Warm perfusion.
Yeah, it continuously pumps warm, oxygenated blood enriched with nutrients through the organ. It's designed to keep the organ in a state much closer to how it would be inside the body, almost functioning.
Wow. So it's not just paused, it's maintained.
Precisely. And that near physiological state, it offers some really compelling advantages. First, it means they can potentially use more organs.
How so?
Well, some organs might be considered sort of borderline, maybe a bit risky if you just use cold storage. With the OCS, you can actually assess the organ while it's on the system, see how it's functioning, maybe even, improve its condition slightly before transplant.
So organs that might have been discarded before, they get a second chance. That sounds huge for patients on the waiting list.
It really is a potential game changer. Another major benefit is reducing damage from the lack of blood flow. Ischemia, technically.
Right, when the blood supply is cut off.
Exactly. That causes damage. The OCS aims to minimize that. Plus, because the organ is sort of working on the machine, doctors get a much better idea of its health before they put it into the recipient.
Which hopefully leads to better outcomes.
That's the goal. And here's a really key point. The OCS is currently the only technology that's FDA approved in the U.S. for this kind of warm perfusion for all three of those major organs, lung, heart, and liver.
Only one for all three with warm perfusion. Wow. That sounds like a serious competitive edge.
It is, but it's not just about the machine itself. You mentioned the National OCS program, the NOP.
Right. What's that all about? Is it just support for the machine?
It's much more than that. The NOP is really TransMedics offering an end-to-end service. It wraps everything together to make the whole process simpler for the transplant centers.
How does it do that?
Well, a huge part of it is logistics. They have their own fleet of aircraft.
Their own planes for organs.
Yep. As of the end of March, they had 21. They've added more since. This dedicated aviation handles the incredibly time-sensitive, complex job of flying the organ from the donor hospital to the recipient hospital.
Okay, that's pretty unique.
It is. And besides the planes, the NOP also provides clinical support teams on the ground, plus extensive training for the hospital staff using the OCS. So it's the machine, the transport, the people, the training, the whole package.
So instead of the hospital trying to juggle all that, finding a plane, coordinating everything, TransMedics basically takes care of it.
Exactly. That's the value proposition. Look, the OCS technology itself, it's more expensive upfront than simple cold storage. No doubt about it.
Right.
But the NOP, by handling all that logistical complexity and ensuring quality control, it actually lowers the barrier for hospitals to adopt this advanced tech.
Ah, I see. It makes it easier for them to actually use the fancy machine.
Precisely. And that makes it easier for them to potentially increase their transplant numbers, maybe improve outcomes. Plus, it builds a really strong relationship. Once a hospital is integrated with the NOP, the logistics, the training, it's harder to switch. Creates stickiness.
That makes a lot of sense. So the NOP is a big part of their strategy, not just the OCS device. Okay, how do they make money from all this? What are the revenue streams?
Two main streams. First, you've got product revenue. That's selling the OCS consoles, the machines themselves, and also the disposables, the single-use kits you need for each transplant.
The consumables.
Right. Second, there's service revenue, and that comes from the NOP. So the logistics, flying the planes, managing the transport, plus the clinical support and training services.
Okay. And how's that mix looking?
Well, what's interesting is that the service revenue slice of the pie has been getting bigger.
Ah. Does that affect margins?
It can. Service revenue generally tends to have a slightly lower gross margin than selling the product itself. But on the flip side, it provides a more recurring, predictable income stream. It's less lumpy than just selling consoles.
Got it. So they're building this integrated solution, part product, part service. Let's zoom out a bit. The organ transplant world. Is the need really big enough to support this kind of sophisticated, maybe expensive approach?
Oh, absolutely. The unmet need is enormous. Demand for organs just vastly outstrips supply. Globally, hundreds of thousands of people need transplants.
So the market's definitely there.
Definitely. And it's growing. If you look specifically at the market for these organ preservation technologies, estimates put it around $1.2 billion back in 2022, projected to hit maybe $2.1 billion by 2027.
Oh, okay.
But here's a really eye-opening number. Some estimates suggest maybe $6 to $8 billion in potential. Well, value is lost every year just because donated organs are deemed unsuitable and discarded.
6 to 8 billion.
Yeah.
Because they can't be used.
Yeah. Now, TransMedics Tech aims to make some of those previously unusable marginal organs viable, but it's not a magic bullet for everything. There are still logistical issues at the procurement organizations, and even warm perfusion has limits for really damaged organs.
Right, so there's still a gap. Understanding those specific bottlenecks seems key for their future growth, doesn't it?
Absolutely. If they can help solve more of those issues, the potential is massive.
So what's driving the growth overall? Why is this market expanding?
Several things happening. The sheer number of transplants is going up worldwide. Then you have rising rates of chronic diseases, things like liver disease, heart failure that lead to organ failure. The population is aging, which also contributes.
Makes sense.
Plus, there's thankfully growing awareness about organ donation. And then, crucially, you have technology like the OCS making it possible to use organs we couldn't use before these extended criteria organs.
Okay. You mentioned earlier, kind of an analogy, TransMedics as a picks and shovels provider. Can you explain that quickly?
Sure. It's like the gold rush analogy, right? Who really got rich? Often it wasn't the miners digging for gold, but the folks selling them the picks, the shovels, the supplies they needed.
The enablers.
Exactly.
No.
TransMedics isn't doing the actual surgery. They're providing the critical tools, the OCS and the essential services, the NOP logistics, that the transplant centers, the miners, need to do more transplants, hopefully more successfully.
So as transplant activity grows, they benefit.
That's the idea. They're selling the tools for the modern transplant gold rush, if you will.
Got it. That's helpful. Now, medical technology. Regulations must be huge. What's the landscape like for them?
Oh, critical. As we said, they've already got those key FDA approvals for lung, heart, and liver OCS use. That's massive. Looking bigger picture in medtech for 2025, well, there's always a push for more global harmonization of rules. Makes things easier, potentially.
Okay.
AI and machine learning in devices, that's a hot topic. Regulations are still evolving there. Cybersecurity is another big one for connected devices. And you even have some supportive legislation like the Securing the U.S. Organ Procurement and Transplantation Network Act, aiming to improve the whole U.S. system.
So a complex area, but maybe some tailwinds too. Now, competitive advantages, their moat. We touched on the FDA approvals and the NOP. What else gives them an edge?
They've built a pretty decent moat, I think. First, the technology itself. It's proprietary, protected by patents, and it's just technically complex to develop and build. High R&D cost barrier. They spent $56 million on R&D last year alone.
Wow.
Second, as we keep saying, that NOP is a huge differentiator. Owning and running your own airline for organs, that's tough for anyone else to copy quickly. Gives them control, reliability.
Right, the aviation part seems key.
Third, they're building up clinical data showing the OCS works, that it improves outcomes compared to cold storage. Evidence matters. Fourth, brand recognition. They're known now, have relationships with, over 65 top transplant centers?
And fifth,
Stickiness. We mentioned it with the NOP. Once a hospital integrates their system, their logistics, their training, switching becomes a major hassle. High switching costs.
so patents, complexity, logistics, data, brand, and switching costs. That sounds pretty solid. Do we know their market share?
Yeah, the numbers show strong growth. Their overall share in the U.S. for OCS, heart, lung, liver combined apparently grew from around, maybe 7% in 2022 up to about 21% in 2024. Another source said 13.8% in 2023 to 20.9% in 2024. So significant gains.
You're taking share.
And in the specific niche of portable organ preservation and specialized transport, they seem to be the dominant player, maybe around 65% share.
But they're not totally alone, right? You mentioned competitors earlier.
No, definitely not a monopoly. There's Organox. They're focused just on liver perfusion with their Metro device, also FDA approved. And liver is a big part of TransMedics business right now, so that's direct competition. They're well-funded too.
Okay. Organox for liver. Who else?
XVO Perfusion. They have a broader portfolio, strong history, especially in lungs. Their Perfade X Plus solution is apparently used almost everywhere for lung transplants. They also have machine perfusion systems.
VVO is strong in lungs.
Yeah. And then there's Paragonix Technologies. They offer various systems, some with perfusion, but historically they've been more focused on advanced cold preservation techniques. Still, they're in the game.
So while TransMedics has that unique triple organ warm perfusion approval and the hard-to-copy NOP aviation, these other guys are pushing hard in specific areas.
Exactly. Organox, specializing in liver, gives them an edge there. XVVO's dominance in lung solutions is significant. Paragonix offers alternatives. TransMedics can't rest on its laurels. They need to keep innovating and proving their value, especially in those key organ segments like liver, where competition is heating up.
Got it. Competition is definitely a factor. Okay, let's shift gears. Chapter 2, management evaluation. Who's steering the ship?
Well, at the helm is Dr. Waleed Hassanein. He's not just the CEO. He founded the company way back in 1998.
Wow, since the beginning.
Yeah, nearly 27 years. That's a long tenure. Shows deep commitment. His compensation in 2024 was around $8.2 million salary, bonus, stock, options. Pretty standard range for a CEO of a company this size.
Does he have skin in the game? Ownership?
He does. A significant amount, actually, around 1.42% of the company. At the current price, that's worth well over $50 million, about $58.5 million.
Okay, so his interests are definitely aligned with shareholders. A founder CEO with a big stake that's often seen as a positive sign.
Generally, yes. He's obviously been central to their entire journey, from R&D to getting the NOP off the ground. Seems very confident in their ability to execute, too, based on recent calls.
What about the rest of the team? And the boards?
The broader executive team has an average tenure of about 4 years. The CFO is relatively new, started late 2024. But the chief commercial officer, Tamer Kayal, he's been there over 19 years, so a mix of experience.
Okay, and insider ownership beyond the CEO?
Yeah, other execs hold shares. We saw some recent share acquisitions, probably tied to compensation plans. There have also been some insider sales, though, by directors and officers, including the CEO.
Sales? Should we worry about that?
You always have to look at the context. People sell shares for lots of reasons: taxes, diversification, buying a house, whatever. It doesn't automatically mean they think the company's going down. But yeah, it's something investors track.
Right. Context is key. How about the board of directors?
Average tenure there is quite long, almost 12 years. James Tobin is the independent chairman. Long tenures. Well, it means deep knowledge of the company, stability. But it can also raise questions about, fresh perspectives. Is there enough board refreshment? Some reports noted a potential concern about insufficient new directors.
Okay. Something to consider.
And we can't ignore the elephant in the room, that ongoing class action lawsuit. It alleges issues with some execs. That inevitably puts more scrutiny on the board's oversight role.
Definitely. We'll need to circle back to that lawsuit later.
Okay.
Okay, so how are they using their money? Capital allocation.
Their strategy seems laser-focused on growth. Big chunk goes to R&D, as we mentioned, keeping that tech edge. $56 million last year, over $17 million just in Q1 this year.
Investing in innovation. Makes sense. What else?
Expanding the NOP infrastructure. That's huge. Buying more planes, up to 21 now. Building new facilities like the planned one in Italy for design and manufacturing.
That decision to own and operate the planes, that seems like a defining choice.
It really is. It's a massive capital investment, comes with ongoing operating costs, aviation risks.
Yeah, running an airline isn't trivial.
Not at all. But the payoff is control, reliability. It reinforces that NOP mode.
Yeah.
And we're seeing it pay off in their growing logistics revenue.
So heavy reinvestment in tech and infrastructure. What's their debt situation like? Are they funding this with debt?
They do have significant debt. End of Q1 2025, they had about $450 million in net convertible senior notes, plus another $60 million or so on other long-term debt.
Okay, that's substantial.
It is. Their interest expense in Q1 was around $3.5 million. But on the other hand, they also had a healthy cash pile, about $310 million in cash at the end of March. So debt exists, but there's a cushion.
A decent cash buffer. What about shareholder returns? Dividends? Buybacks?
Nope, no dividends right now. No active share buyback program either. They have issued shares in the past to raise capital, which is common for growth companies, but it dilutes existing shareholders.
So the focus is purely on reinvesting profits back into the business.
Seems that way, yes. All about fueling that future growth at this stage.
Okay. Makes sense for where they are. Let's move on to Chapter 3, Financial Health. The numbers. How has performance been lately?
Lately, it's been pretty explosive on the top line. Revenue growth has been remarkable.
How remarkable?
Well, fiscal year 2024, total revenue jumped 83% to hit $441.5 million. That's huge growth, driven by more OCS use and that growing NOP service revenue.
83%. Wow. Did that continue into this year?
It did. Q1 2025 revenue was up 48% year over year, came in at $143.5 million, and they felt confident enough to raise their guidance for the full year 2025, now expecting between $565 and $585 million.
Okay, impressive top-line momentum. But growth often comes at the cost of profit, especially early on. How are their margins and profitability looking?
That's the other big part of the story. They've turned profitable. Gross margin dipped slightly in 2024 to about 59%, maybe because that growing service mix we talked about.
Which has lower margins than product.
Right. But it bounced back to 61% in Q1 2025. More importantly, they swung from an operating loss in 2023 to an operating income of $37.5 million in 2024.
That's a significant turnaround.
Huge. And Q1 2025 operating income was strong too, $27.4 million. That's like a 19% operating margin. Net income followed suit, $35.5 million profit in 2024 versus a loss the year before, and $25.7 million net income in Q1 this year.
And earnings per share?
Positive. Diluted EPS was $1.01 for 2024 and $0.70 for Q1 2025, which actually beat analyst estimates.
Hitting profitability and beating estimates. That explains some of the stock surge, I guess. What about the balance sheet overall, financial stability?
Okay, end of March 2025, total assets $726 million. Key things there are the cash, $310 million, and receivables, $142 million. Total liabilities about $560 million, including that debt we discussed. Leave stockholders' equity around $165 million.
So liabilities are quite a bit higher than equity.
Yeah, the debt-to-equity ratio is high, around 3.14, so it's leveraged. But as we said, they have that big cash balance. Their liquidity looks strong. Current ratio seems very healthy, maybe around 10, suggests they can easily cover short-term bills.
Leveraged, but liquid. Got it. How efficient are they at using all that capital they've raised and invested? What about return on invested capital, ROIC?
Calculating ROIC precisely is tricky without all the internal numbers, but based on available data and what analysts report, it looks like it's been somewhere in the, say, 8% to 12% range recently.
Is that good?
Generally, yes. If your ROIC is consistently above your cost of capital, the cost of your debt and equity funding, it means you're creating value. 8–12% suggests they're likely clearing that hurdle. It's a good sign for capital efficiency.
Okay, encouraging. Now, profit on the income statement is one thing. Are they actually generating cash? What's the free cash flow situation?
Nah, that's the crucial point right now. Despite the strong net income, their free cash flow in Q1 2025 was actually negative, minus $29.9 million.
Negative. Why, if they're profitable?
Because they're still investing so heavily back into the business. Buying those planes, building facilities, funding R&D, that eats up cash even if the operations themselves are profitable on paper.
So cash is going out faster than it's coming in for now.
For Q1, yes. Now, analysts do expect them to turn free cash flow positive in the coming years as those investments hopefully start generating more revenue and require less upfront cash.
But it's not there yet.
Not yet. And ultimately, sustainable positive free cash flow is what really drives long-term value. So that's a really key metric to watch. Their current valuation is definitely banking on strong future cash flows.
Okay, that's important context. Growth, profitability achieved, but still burning cash on investment. That definitely shapes how you'd value them. Speaking of valuation and market views, let's move to Chapter 4, Market Sentiment. What are the analysts saying now? Price targets.
Analyst sentiment seems generally positive, but maybe a bit cautious after the recent run-up. The average one-year price target is around $119.85 to be exact.
Which is slightly below where the stock is trading now.
Exactly. The stock at $122 is a bit ahead of the average target, though the range of targets is pretty wide from like $81 up to almost $188. So opinions vary.
What about ratings? Buy, sell, hold?
Mostly buys. Recent ratings include outperform and overweight reiterations. There was one recent hold, though, and a previous downgrade to neutral from one firm. Overall, something like 84% have Y ratings, 15% hold.
So generally bullish, but maybe thinking the price got a bit ahead of itself. What about the bears? We mentioned high short interest earlier.
Yeah, that's still a significant factor. As of late April, mid-May, short interest was high, around 8.8 million shares short, taking maybe 8 or 9 days to cover based on volume. That represented about 21% of the float.
21%, that's really high. What does that signal?
It signals strong bearish conviction from a decent chunk of the market. They might be betting against the valuation, worried about competition, the lawsuit, or maybe just skeptical the profitability is sustainable.
But you said it could also lead to a short squeeze.
Right. If good news hits like those strong Q1 earnings, did short sellers rush to buy back shares to close their positions, which can push the price up even faster? We might have seen some of that. And the short interest has come down a bit from its peak earlier in the year, but it's still elevated.
So a real tug of war between bulls and bears reflected in the short interest. Any clues from the options market?
Options activity can give you a sense of expected volatility and where traders are placing bets. We saw a pickup in activity after the earnings beat in early May, which isn't surprising. Looking at which strike prices and expiration dates are active can sometimes offer hints about sentiment, but it's complex to interpret definitively.
Okay. And summarizing the recent news and overall investor vibe.
Short term, definitely positive buzz from the earnings beat and raised guidance that fueled the big stock surge. But that class action lawsuit is still hanging out there. That's a definite negative, keeps some investors cautious. So it's a mix. Excitement about the growth and profitability, tempered by valuation concerns and the legal overhang.
Understood. Okay, let's shift to Chapter 5, ownership structure. Who actually owns TMDX? Major holders.
Big institutions are definitely involved. You see names like BlackRock, Fidelity, Vanguard holding significant stakes. Looking at recent filings, you can sometimes see if they're adding or trimming their positions, which gives a hint about their conviction. Seems like there's been some active trading, both buys and sells, from these big players lately.
So the big funds are actively managing their stakes. What about insiders? We know the CEO has a lot. What's the total insider ownership?
Total insider ownership is reported around 17%, 16.97% technically. That's pretty significant.
Yeah, that's a good chunk.
Includes the CEO's stake, shares held by other execs and directors. We mentioned those recent non-open market acquisitions, likely comp-related, and the sales too, which need context. But overall, nearly 17% ownership suggests management's interests are reasonably aligned with shareholders.
Okay, significant institutional backing and meaningful insider ownership. Now, let's get into the risk more formally. Chapter 6, risk assessment, using that SWOT framework. Strength, weaknesses, opportunities, threats. Let's start with strengths.
Okay, strengths. Proprietary OCS tech, FDA approved for the big 3 organs. The integrated NOP, especially the aviation part, that's a huge barrier. Growing clinical data backing it up. Rapid revenue growth. They just hit profitability, gaining market share, and the experienced founder CEO.
Seems like a strong list. What about the flip side? Weaknesses.
Weaknesses. They're heavily reliant on that one main OCS platform right now. Huge ongoing investment needed for R&D and NOP expansion, which hits free cash flow. Significant debt load. Profitability is recent, not yet proven long-term. Scaling up manufacturing and logistics could be challenging, and they're still smaller than some big medtech players.
Okay, realistic weaknesses. What about opportunities? Where could they go from here?
Opportunities look pretty big. Huge untapped global market for organ preservation. Potential to expand OCS to other organs like kidneys eventually. More market share gain is possible. They could leverage the NOP infrastructure for even more services. And that new facility in Italy could boost European ops and maybe help with the supply chain.
Lots of potential upside. And finally, the threats. What keeps them up at night?
Threats. Intense competition, Organox in liver, ex vivo in lung, Paragonix. Those U.S. tariffs from this year could hurt costs. That serious class action lawsuit major risk, the ever-changing regulatory and reimbursement landscape, an economic downturn hitting hospital budgets, losing key people, supply chain disruptions, managing their airline. And maybe, long-term, totally different technologies emerging.
Let's dig into a couple of those threats, those U.S. tariffs from 2025. How might they specifically impact TransMedics?
Well, the U.S. put new tariffs on various imports in April 25, including some medical gear. Even if TransMedics assembles the main OCS console in the U.S., they almost certainly use imported components for the consoles and the disposable kits.
So their costs go up.
Right. It could directly increase their cost of goods sold, squeezing gross margins. Then they have to decide, absorb the cost, hurting profit, or pass it on to hospitals, maybe hurting sales.
Tough choice. Could the new Italian facility help?
Potentially in the long run. It might help diversify their supply chain, maybe source some things outside the tariff zone, especially for Europe. But short term, those tariffs are a potential headwind.
Okay. And competition Organox, XEVO, how real is that threat?
It's very real. Organox focusing solely on liver, a key area for TMDX, and being well-funded. That's direct pressure. XEVO has that deep incumbency in lung centers globally with their established solution, plus other technologies. Paragonix offers alternatives.
So TransMedics needs to keep proving its worth.
Absolutely. They have their unique advantages, the triple organ approval, the NOP, but they have to consistently show better clinical outcomes and economic value to win against these focused competitors, especially in high-volume areas like liver and lung.
Makes sense. And the regulatory and reimbursement risk, anything specific there?
Well, it's ongoing. They rely on keeping those FDA approvals and getting new ones. But crucially, they need payers, Medicare, insurance companies to keep reimbursing generously for both the OCS use and the NOP services. If reimbursement rates get cut, that directly hits their revenue and adoption. Plus, just keeping up with all the general medtech rules, safety, data, cybersecurity, it's constant.
Okay. And finally, that lawsuit. We need to understand the potential impact. What are the core allegations and risks?
It's a securities class action. The core allegations are pretty serious. Claims that the company misled investors about product safety and efficacy and engaged in improper business practices like kickbacks or fraudulent billing. These gained traction after a letter from a congressman and a short seller report.
And TransMedics' response?
They've denied it all, said they'll fight it vigorously, but just fighting it costs a lot in legal fees and distracts management. The negative headlines could make some hospitals pause before adopting.
If they lose or settle.
Could mean significant financial penalties, reputational damage. It's a major overhang, a big uncertainty clouding the picture right now. Investors have to watch how this unfolds.
Definitely a critical risk factor. Okay, Chapter 7. Conclusion. Let's synthesize. We asked earlier.
Yeah.
Is TMDX a wonderful company in the value investing sense?
It's complicated. Tick some boxes. Understandable business, addressing a huge need, potential for good long-term economics. Definitely seems to have a moat. Experienced founder CEO with skin in the game.
Right.
But the valuation looks very stretched right now. Little margin of safety at this price. And that lawsuit raises serious questions and uncertainty, particularly around management integrity, which is crucial for value investors.
How does it stack up against, say, Buffett's principles?
Well, the moat seems plausible. The recent financial turnaround is impressive, but margin of safety, tough sell currently. And the management integrity aspect is clouded by the litigation, so it's a mixed bag through that lens.
So looking ahead, what are the absolute key things investors need to keep monitoring?
Okay, top things. NOP expansion rate, are they still adding centers and planes effectively? Margin sustainability, can they keep margins up or even improve them as they scale? Free cash flow generation, when do they turn consistently positive? The competitive front are Organox, VVO gaining ground, the lawsuit, any developments, resolution, the Italian facility, does it come online smoothly, provide benefits, and any shifts in regulations or reimbursement.
That's a good checklist. So, bottom line, based on everything we've discussed, investment thesis and recommendation.
Look, TransMedics is undeniably exciting. Pioneering tech, unique service model, huge market need, recent strong performance. Hard not to be impressed by the growth story.
There's always a but.
But the current valuation is sky high. The litigation risk is significant and unresolved, and they're still investing heavily, meaning cash flow isn't positive yet. So at this specific price, with these uncertainties, it feels like the risk-reward isn't quite compelling enough for a new investment.
So the recommendation is,
Our take is avoid Monitor. It's a fascinating company, definitely one to watch closely, but we'd want either a much better entry price or some resolution to that big lawsuit cloud or clear evidence of sustainable free cash flow before jumping in right now.
a cautious stance given the current picture. Makes sense. That was a really thorough deep dive, thanks.
You're welcome. It's a complex one.
So listener, what do you think? Where is organ transplantation heading, and what role will companies like TransMedics play? Let us know your thoughts. And hey, if you found this deep dive valuable, do us a favor, hit that like button and subscribe to Stock Analytics AI for more.
Yeah, subscribe.
And remember, for our Euro 4.99 a month members, got a ticker you want us to tackle next? Analysis, earnings review, send it over, and we'll prioritize it. We've got another interesting deep dive coming up soon based on listener sources, so stay tuned for that.
And yeah, keep sending us those sources and ideas for future deep dives. We appreciate it.
Absolutely. Subscribe to Stock Analytics AI on YouTube.
And just the final disclaimer, research for this deep dive was compiled using AI analysis of the provided source material, current as of May 20, 2025. It's for information only, definitely not investment advice. Always talk to your own qualified financial advisor before making any investment decisions.